What if I told you that with as little as $50 and 10 minutes a month, you could own a small part of Apple, Tesla, or Amazon? Sounds wild, but it's true. Today, I'll show you step by step how anyone can start investing in the stock market in 2026, even if you know nothing right now. I'll keep this quick and simple. By the end, you'll know the first things to do and the mistakes to avoid. Step 1, ask, why am I investing? Are you saving for retirement, a down payment, or just growing extra cash? Your goal decides how much risk you can take and how long you'll leave your money invested. If your goal is more than 5 years away, stocks are a good option because they can grow more over time. Before investing, have an emergency fund, enough to cover at least 4 to 6 months of expenses, and try to pay off very high interest debt first, if possible all debt. This keeps you from being forced to sell investments if something unexpected happens. A stock is one small piece of a company. An ETF, exchange traded fund, or index fund is like a big basket holding many stocks. For beginners, ETFs or index funds are often the smartest choice because they spread risk across many companies. You need 2 things, an account and a brokerage. The account type depends where you live. Retirement accounts like a 401k or IRA in the US or TFSA/RRSP in Canada help with taxes while making your tax-free money grow. The broker is the app or company you use to buy investments like Robinhood in US and Wealthsimple or Questrade in Canada. Nowadays, many brokerages let you buy fractional shares. That means you can own a piece of an expensive stock with only a little money. For example, if you want to buy or can afford to buy only half stock of Netflix or Apple or any of your favorite company that you want to own, a piece of you can do that via your investment app. You just need to choose a simple strategy. Start small and be consistent. Even $25 a week helps. Use dollar cost averaging, which means invest the same amount at regular intervals to avoid trying to time the market. For example, if you are buying a single stock, like Nvidia in this case, but 1 or 2 stocks every single month, and it does not matter how the stock looks like. If it is down or high, that way you need to analyze the market and just buying an average price of the stock in long run. If not stocks, then just focus on low-cost index ETFs or funds that track the whole market. Hold for the long term. Don't panic at short dips. Think as an owner, not as a borrower. To start with, I would always recommend to pick one broad ETF that covers the whole market, a total market ETF, or something like SCHD or S&P 500 ETF. These give instant diversification. You own hundreds or thousands of companies at once. If you want some balance, add a bond fund, especially if you're closer to needing the money. Open your account, deposit money, search the ETF ticker. That's its short code. Choose how much to buy, and press Buy. If your broker offers fractional shares, you can type the dollar amount you want to invest instead of buying full shares. Don't try to time the market or chase hot tips. Avoid panic selling during dips. Keep emotions out of investing. A simple, regular plan beats jumping in and out. Diversify. That means don't put all your money in one stock. If your portfolio drifts, for example, stocks grow faster and now make up more than you planned, rebalance by moving money to the parts that fell behind. Rebalancing keeps your risk level steady. Read a little each week, ignore noisy social media advice, and let time work for you. Over years, compounding can be powerful. That's it. The simple path to start investing in 2026. Set a goal. Save an emergency fund. Pick low-cost ETFs. Invest regularly. And ignore the noise, and you will be millionaire before the retirement age and can retire early as well.